Hi guys, Niall here with another members video. Now today's video we're going to be looking at trends and trend analysis. Now the thing that has been popping up in the forum and on the email support line has been questions about finding the trend in confluence. Now confluence is that word that I use often. It's when things align, when there's many variables aligning in the market such as a level, the trend and a signal all in alignment. That is called confluence. All those things together back up the trade and confirm the trade. So I'm looking at the Aussie dollar on a daily chart. Now the Aussie dollar is my local currency. It's moving aggressively to the upside at the moment. We've been in a long-term bull market. It's pretty obvious on this chart, just looking at it from June 2010 to the end of December 2010. That's about 6 months of data. You can see that it has been quite bullish with only a few short-term pullbacks. That brings me to the first point or lesson here with trends. If you can look at 6 months of data, the general direction or the most obvious pattern that is being created is usually the direction you should be trading in. So if the pattern is sideways in a very obvious range, you'll be trading probably the swings up and down in that range. But in this example, we're in a long-term uptrend, so we'd be trading on the long side or the buy side. And obviously, if you had a downward sloping trend, you'd be trading shorts or selling. It might seem too simple or too obvious that you follow the obvious direction of the chart over a 6-month period, but there is another confirming stage or confirming factor you could add to that rule. So the first rule is the obvious slope of the market over 6 months. The second would be looking at the 8 and 21 day exponential moving average and then trading the crossovers that align with that long-term direction. So we've got the long-term direction being up. Sorry, that's the wrong tool. We'll use this one. The long-term direction is up, and every cross to the upside in the moving averages would be our first filter for a long setup. And you can see that the market initially popped up in June 2010, retraced a little bit, and then went on a nice trending move up for around a month and a half, pulled back slightly, the moving averages then crossed up again. Then we uptrended from August through to, I think it was around the beginning of November. Then we crossed down again, and then recently, around 3 weeks ago, crossed up. So there has been 1, 2, 3, 4 opportunities where the moving averages were positively crossed to the upside, which was in alignment with the long-term uptrend. And when those conditions were met, we could be trading longs. Now this is just my way of looking at things. Now there is different ways that you could define the trend on different time frames, and there's all kinds of things you can use, such as the swing highs and swing lows. If you're getting higher highs like this, that's an uptrend. If you're getting lower lows like this, it's a downtrend. It's not always a concrete thing, but I just like to look at the long-term momentum that's in the market and trade in the direction of the 8 and 21 day exponential moving average. It's just a really simple way to gauge the short-term momentum. Now I'll just get rid of that. The other thing that I want to point out, this is the third variable, is the levels in the market. And you can see that levels on the long-term chart are very relevant. Just drawing them in now, and you can see the most obvious points that are lining up here. If you can just bear with me and use your imagination here, the market moves in this kind of matrix of levels. There is a self-fulfilling event with levels. A lot of the time it's not so much that the levels mean anything, it's just that when one level is worked out as a turning point, it might have just been random chance that it was initially a turning point. Say we had 99.90 as a level there right here on the Aussie dollar. The first time it made a high there, and then we retraced, and then we retested the level again. The second time that it retested that level, it was a self-fulfilling turning point. I mean, so many traders are watching the market that those levels just become value points because that was the most recent point that they have as reference. Now, as you can see, levels all through this chart are extremely relevant. And when I say use your imagination before, I'm saying that there is no concrete strategy here with trends and levels. You've just got to work with the market, let it show you what it wants to do. And a lot of the time these levels will hold or break, or there'll be false breaks around the levels. You've just got to be flexible, and that's probably the more appropriate word. Being flexible and not having a concrete set of rules with trend analysis and levels will save you in the long run, because you'll be lenient with the levels. They might be 10 or 20 points out, they're not going to align perfectly, but if we just zoom in this chart, you'll see what I mean. These highs here aren't perfect. This level at 99.90, I think it is. Let me get rid of that line. Yeah, it's 99.90, and then there's another one there it's about 1.028, so it's just above parity. You can see the market was, hovering just under parity at 99.90, and then we punched through by about 25 points right here, right there. We just punched through it only a little bit, just by 25 pips rather. Now you can see that obviously contained the market, and it's around that 99 level, so we'll give it the benefit of the doubt, and as I say, we'll use our imagination and just say that that level is around the parity or 99.90. Even though we did puncture through it, you've got to be lenient with these levels. We then broke through, so when we moved through and the market then retested, you can see it held around that level. You can see it's not perfect. It didn't stop right there. It's just stopped right there at the 8-day moving average, 8-day exponential moving average, but it's also aligning with these areas here. And you can see that's an obvious level that's been broken, it's been retested, and now the market is proceeding up towards the recent highs there at 101.73. Now that's the only recent high that we have as reference. Remember I said that these levels become self-fulfilling, so this is where most people are probably targeting if they are long on that inside bar breakout that just happened, or if they're long from anywhere through here. That's where they're probably targeting, is this level up here. Now the market's probably going to break through that level, and I wouldn't be surprised if it traded up towards the 102, 103 level pretty quickly. But what's important to know is that we are in a long-term uptrend, we are in a short-term uptrend as well. We have a bullish setup there. The moving averages were just tested and they held. The level was tested and held. And just by making all these observations, we can deduce that the market is going to be pushing higher. That is the reasonable expectation, based on all the evidence that we've just looked at. The confluence aligns to the upside. So as I say, there's no real way to automate trend analysis. There's no concrete set of rules. You've got to use your experience, your gut feel, and just a general knowledge of charts to plot the levels, find the long-term trend and the short-term trend, look at the price action and how it's behaving around the levels, around the moving average, look for an obvious slope in the market. You should always be looking for some kind of direction, and you can see just by basic visual analysis we have a upward movement there. We also have it through here. This is congested. We had a little pop up there and then we trended down. This is just basic directional analysis, and when these swings align with that longer term trend, that's when we want to be trading those signals that I teach in the course. That's all for today's video. I hope you enjoyed it. I'll see you in the next tutorial.